Hi, Gary DeWaal here, and this is Bridging the Week for June 16th to 20th, and today is June 23rd, 2014. Good morning. Last week it was speeches by key regulators. This week, reports provide the food for thought regarding certain worldwide financial industry trends, including repercussions of directing more trades to central clearinghouses. In addition, the U.S. Securities and Exchange Commission brought its first enforcement action against the firm and its owner for retaliatory actions taken against a whistleblower. We have these stories and more this week on Bridging the Week, so let's get started. In its survey of securities markets risk trends 2014, the research department of the International Organization of Securities Commissions summarized the results of an in-depth survey of both industry leaders and regulators of their views on risk to and within the global securities markets. Not surprisingly, risk assessments by regulators and industry personnel differed. While regulators were most concerned about risk arising from illegal conduct and breakdown in corporate governance, financial risk disclosure, and benchmarking, industry participants were more concerned about the search for yield, resolution and recovery plans, central clearinghouses, and market fragmentation. Separately, the London School of Economics and the Depository Trust Clearing Corporation published a study related to the use of collateral assets as a result of regulatory reform and changing market practice. The report concludes that overall, there is sufficient collateral worldwide to meet projected demand. However, weaknesses in market infrastructure may likely cause collateral to be immobilized, at least temporarily, in one part of the system when it is needed in another part. In connection with central clearinghouses, respondents to the IOSCO survey expressed concern regarding, quote, forcing markets to concentrate large risks into central clearinghouses that are becoming too big to fail, end of quote. Respondents to the IOSCO survey also expressed concern that uncoordinated regulation could cause market fragmentation, quote, which will impact on liquidity levels and trading volumes, end of quote. Separately, the LSC and DTCC report also raised concerns regarding the move towards centralized clearing and standardized platforms because the new paradigms increase collateral demand for initial margin. Although the LSC and DTCC report conclude there are likely sufficient high-quality assets outstanding worldwide to meet the anticipated demands of collateral going forward, this analysis is based on the assumption that collateral can circulate freely within the financial system. To a certain extent, this may not be true because certain collateral that may be considered high value at any one time, such as certain sovereign debt, may be downgraded at another time. Also, certain historic collateral transformation abilities of large banks are being eroded by quote-unquote increased regulatory constraints. These are interesting documents that are well worth reviewing. The U.S. Subcommittee on Investigations held a hearing last week to consider high-frequency trading in U.S. stock markets. The hearing focused on payments by wholesale brokers to retail brokers for their customer orders and so-called payment for order flow and maker-taker rebates or fees by execution facilities that result in payment or charges to brokers to execute on their platforms. The UK Financial Conduct Authority has published a paper describing how it will address regulated firms that fail to meet its minimum standards regarding culture, business models, and strategies, and governance. Where FCA finds evidence that a firm fails to meet its minimum standards, it will place the firm on an enhanced supervision program, or possibly take other regulatory action, that will require the firm's supervisors to review its supervisory strategy and return the firm to normal supervision by a specified date. FCA will monitor progress against this plan and on a regular basis and take corrective action if the firm is not on course to deliver a successful outcome. Vision Financial Markets agreed to withdraw its membership with the NFA as a futures commission merchant within 6 months and pay a fine of $1.5 million in response to the NFA, or the National Futures Association's complaint related to its alleged failure to prevent the misallocation of trades by one of its so-called preferred commodity trading advisors, Ace Investment Strategists. This failure, charged the NFA, resulted in customer losses in excess of $2 million. Without membership in the NFA, Vision cannot act as a futures commission merchant. Previously, Vision had paid full restitution to its customer. In the complaint against Vision, NFA cited 4 prior disciplinary matters involving supervisory issues from 1993 to 2011. The Securities and Exchange Commission settled charges last week against Paradigm Capital Management, Inc. and investment advisors, and Candace Weir, its founder and president, related to their taking retaliatory actions against Paradigm's former head trader. These actions were taken, claims the SEC, after the former head trader reported to the SEC that Paradigm had engaged in principal transactions with an affiliated broker-dealer owned by Ms. Weir without adequate disclosure to or consent from a relevant customer advised by Paradigm. This is the SEC's first case relying on a rule it adopted under Dodd-Frank that permits it to bring enforcement actions for retaliatory actions against whistleblowers. As part of its settlement, respondents agreed to pay disgorgement, prejudgment interest, and a civil penalty totaling in excess of $2.1 million and retain an independent consultant. The Canadian Securities Administrators have approved rule amendments that impose investment restrictions and operational requirements, as well as enhanced disclosure obligations regarding securities lending activities on non-redeemable investment funds. And finally, in a speech before the Economic Club of New York last Friday, SEC Chair Mary Jo White called for the use of technology to help improve pre-trade pricing information in the fixed income markets. She lamented that, to date, while it appears that technology has materially transformed equity markets, it has not helped investors in the fixed markets arena. As a result, she says, the SEC will work with the Municipal Securities Rulemaking Board to finalize a best execution rule for the municipal securities market. The SEC will also work with the MSRB and the Financial Industry Regulatory Authority to develop rules by year-end regarding the disclosure of markups in so-called riskless principal transactions related to corporate and municipal bonds. Well, that's it for this week's Bridging the Week. As always, there are more information in each article and more articles on the article version of Bridging the Week on the Gary DeWaal & Associates website. Check it out. Until next week, this is Gary DeWaal. Have a great week, and ciao!